The safest entry in an uptrend usually isn't the breakout, it's the pullback that follows. Chasing the breakout means buying the high and setting a wide stop. Buying the pullback means getting the same trend at a discount, with risk clearly defined. Let me show you exactly how to time it. Here's the anatomy. First, an established uptrend, higher highs and higher lows, ideally with a rising moving average like the 20 or 50 period underneath. Then a shallow, controlled pullback. Price dips back toward that average, usually on lighter volume and smaller candles because there's less conviction in the selling. The depth matters. A healthy pullback is orderly and gives back maybe a third to a half of the last leg up. A violent, deep drop that erases the whole move is a warning, not an opportunity. The key idea is that the dip is a pause that refreshes the trend, not a breakdown that ends it. Strong trends pull back to value and then continue. This is the whole idea in one line: buy strength at a discount. You're not trying to catch a bottom or predict a reversal. You're joining a trend that's already proven itself, just at a better price and with a tighter, more logical stop than the breakout buyer ever gets. Here's the trade, step by step. You don't buy the instant price touches the average. You wait for a reversal signal there, a hammer, a bullish engulfing candle, or a reclaim of a small intraday level. That confirmation is your entry, around 111. Your stop goes just below the average and the pullback low, near 108, because a clean break of that zone means the pullback has become a genuine reversal and your reason for being in the trade is gone. Your target is the prior swing high, and if momentum is strong, a measured extension beyond it. Because your risk is just the shallow pullback while your reward is the next trend leg. A clean pullback entry routinely offers 2 or 3 to 1, and you're trading with the trend where the odds already favor you. And the trap that ruins this setup, confusing a pullback with a falling knife. A pullback only exists inside an intact uptrend. If structure has already broken, lower highs, lower lows, a collapsing average, then what you're calling a dip is just a downtrend, and buying it is catching a knife. Confirm the trend is alive before you ever look for the entry. On a real chart, watch how an uptrend that holds above support keeps handing you pullback entries. Each dip toward the level that held was a lower risk way into the same move. You didn't need to predict anything. Just react to price returning to value. Notice too that the best pullbacks often pause exactly where a moving average and a prior support level line up. That overlap is extra confluence. And the moment that level finally broke and price started making lower lows, the pullback edge was gone. That break is the precise line between a dip worth buying and a falling knife worth avoiding. The trend, not your opinion, decides which one it is. Where it fits, the pullback is a price action entry that leans on structure and a trigger. Stack it with a real support level and momentum turning back up, and it becomes a high conviction swing entry. On its own, it's a guess. Inside the confluence stack, it's an edge. So, confirm a real uptrend, wait for the shallow pullback to the rising average, enter on the reversal with your stop just below, and target the trend's continuation. Buy strength at a discount, never a falling knife. Subscribe for the full method and trade your own plan. Education, not financial advice.